And our next guest says that yields are near a peak for the cycle. Let's bring in Charles Schwab's chief fixed income strategist, Kathy Jones. Kathy, thank you for being here. So peak for the cycle. How long is this cycle and where do you see yields going from here?
Well, yeah, great question on the cycle, because this has been a prolonged long cycle. I think we all were sort of expecting a rapid up and down, and what we've gotten is sort of this drawn out cycle because of the Fed's higher for longer. So the cycle will probably extend into next year, but we do think that at some point in second or third quarter of next year, we'll probably see the Fed pivot towards easing rates, because as they've all been talking about in the last day or so, it looks like rates have gone high enough to slow the economy and continue to bring inflation down.
You've got Dallas Fed President Lori Logan saying yesterday a sharp rise in long-term rates in October basically may mean that there's less of a need to further hike from here. Do you agree that the market is adjusting enough so that the Fed doesn't have to? And if we've already seen the peak, will it still do enough in terms of financial tightening that allows for the market to basically say, mission accomplished on this hawkish posture?
Well, I think so. And I think that that's the calculation that Dallas Fed President Logan is making. And she's been one of the more hawkish members. So her shift, even if it's a modest shift, is pretty significant. So what she's been referring to is this term premium, this risk premium that's in the market for the uncertainty about the direction of rates and how that's gone up. And when that goes up, it does a lot of the Fed's work for it. And, yeah, we have seen inflation is trending down. If you look at the core PCE over the last 3 to 4 months, it's already almost at the Fed's 2% inflation target. It's about 2.2 on a 3-month annualized basis. If you look at tightening lending standards at the banks, I mean, that's definitely been a factor that is affecting companies. It's affecting individuals. We're seeing, financing costs for everything from cars to plant and equipment, et cetera, starting to go up, and that tightens up the amount of credit in the economy. And all that should slow things down. It should result in inflation continuing to trend lower. It's going to be a bumpy ride, but I think the Fed has done enough. And remember, they're still doing QT in the background. So just because they stop hiking rates doesn't mean that we won't see more tightening in the pipeline. That's going to happen through quantitative tightening and by keeping real rates high.
Yeah, Kathy, you mentioned the term premium discussion, and it's part of what I call, we're at this phase of the cycle where it's all about the abstractions or these inferred statistical values in there, where the neutral rate, potential GDP growth, all these things you have to make assumptions about and model out. When you bottom line it for a bond investor, what does it mean? Is there now value in parts of fixed income that there wasn't before because you have some kind of yield over and above the presumed inflation rate, say?
Yeah, absolutely, Mike. That's exactly the point. So a couple of things for bond investors. You have real rates. So when we look at the TIPS market and the implied inflation rate, you get 2 to 2.5% almost in terms of real yield there. That we haven't had that since pre-financial crisis days. So you've got some cushion there if the outcome isn't what was anticipated. But you've also got coupon income, and this is hugely important when you're a bond investor. Coupon income is really what you're investing in fixed income for, and that really gives you a lot of cushion on the downside, because your total return is that income component plus or minus the price change, and the price can go down maybe if yields go back up, but you've got a lot of coupon income built in. So if you're an investor in fixed income and you're looking for income, you're not only getting it in nominal terms, you're getting it in real terms. And that should mean that going forward, the risk reward is much more attractive than it has been for several years.
Fascinating. Kathy, thank you.
Thank you.